world. Um, for a start, if you believe Bitcoin is a risk-on asset, and if you believe that when the whole world goes to pieces, Bitcoin will also go to pieces, which, as we've seen last year, may not be true. We've seen it rally as a sort of a safe haven. Nonetheless, it's about the only place in the world I know where you can consistently buy puts and sell calls and make money on that. Whereas that's about the worst thing you can do in the equity world, right? The puts are always overpriced, calls are always underpriced. So this year, that on its own, I don't care about what's happened in a couple of specific instances last year so much as what happens when the world absolutely blows up. And that gives you a very interesting sort of, hedging opportunity. That's a trade I would definitely put in my portfolio, even if it hasn't particularly paid off as a crash protection yet, because it's made money. It's potentially a crash protection that has good positive carry to it. That doesn't exist. So that's terrific. And the other thing that's great is the risk reversal moves around a lot. Like the risk reversal on the S&P is pretty much the same all the time. Equities have a very, very stable risk reversal, but Bitcoin will flip. It'll go from the calls being expensive to the puts being expensive. And it will even do it in different parts of the term structure. Like today's pretty quiet, but if you look today, you'll find that like the February risk reversal is moving in a different direction to the December risk reversal. I mean, and this gives you tons of opportunities to trade. These things just don't happen in TradFi. And it's kind of, the risk reversal is entirely the market's perception of how at-the-money vol is going to change as the spot changes. So it gives you a lot of information there. Like, really, they think this is going to be different in June to December? Why would that be? Think through that for a little bit, and then you can start putting bets on.
This is a follow-up question to that then. Do you think those inefficiencies or discrepancies, whatever you want to call it, do you think they diminish over time? When do you think that sort of like weird market behavior ceases to exist compared to traditional finance markets?
That's a guess. I wouldn't even bother to try and guess that. Like I said before, the Bitcoin world is changing so quickly. Like it's sort of like a child growing up, right? 5 years in the life of Bitcoin is an enormous period, as opposed to an adult. 5 years ago was pretty much the same as now. So the S&P is like the adult. It's not going to change. I mean, a lot of things could happen to Bitcoin. But we're talking about, I don't know what Bitcoin's not a currency, right? Because you can't spend it anywhere. I mean, Bitcoin is clearly something. And what people think it is going to change. And as that happens, the market might grow up or it might turn into a totally different thing.
Mm-hmm. Yeah, definitely agree there. I think another point I'd like to touch on is that within the options and derivative space, right, you obviously need market makers to provide liquidity, and you're seeing a huge range of market makers come in and enter this space, either crypto native market makers or sort of slightly more TradFi entities. So perhaps this one's for you, Greg. How profitable is market making in the crypto volatility space, particularly on platforms like Deribit, for example? And what opportunities does it present for traders?
Yeah, so I think this is really interesting analysis we did. So basically what we did here is we came up with a theoretical fair value of options for every trade. So call it the mark price. And theoretically, market makers have a bid and the ask around the fair value, and they collect a spread. And so I mean, you could make the argument maybe the mark price isn't perfect, but this is good enough for this type of analysis. And so we looked at the 2023 daily total returns, theoretical market maker edge, and then we looked at a per contract trade edge as well for the Bitcoin space specifically. So for Bitcoin specifically, total P&L for market makers or edge paid is about $320,000 per day, $320,000 per day, with a max of 3 million in mid-October when things kind of got crazy. So that's something that's really interesting. But then what's even more interesting from a taker perspective is if we look at the P&L edge paid per trade, per contract, it's only about $10 of spread that the average trade is paying. And this is on like a $44,000 notional asset. So $10 of edge for that much exposure is actually kind of it's not a bad deal. So I think right now, we're really kind of in balance between market maker profits and sort of the edge that takers are paying. But I do think from a market making perspective, the real sort of true potential is that this space should grow. Ultimately, the open interest and volumes of options in the crypto space versus what we would see in traditional equities, like a stock like NVIDIA, you see about 14% notional open interest in the options market versus the underlying market cap. In Bitcoin, it's a little bit less than 2%. So there's a 7x right there, theoretical. And if we look at the ETFs like SPY, it's an even bigger differential. So I think that's the market maker sort of the value proposition, is to be here early and have infrastructure in place. So when the space grows, to really capture a lot of that edge. And then from a taker perspective, venues like Deribit are actually pretty efficient, and you're not getting hosed actually trading these markets.
Greg, I'm curious. Sorry, go ahead, Giovanni.
Maybe if I could add to that a little bit, say from the market maker perspective, right? Certainly, say with the availability of all these different venues where you can get access, say, to cryptocurrencies, Bitcoin, Ether, as well as the others, right? You've got, say, your unregulated centralized exchanges, you've got some of the unregulated derivatives platforms, right? But then, you had the introduction of Bitcoin futures back in December 2017, the introduction of regulated product, the introduction of the BITO product in the fall of 2021, and of course now we have the introduction of the spot U.S. Bitcoin ETFs. And I think what that does for market makers, generally these liquidity providers can trade across all these different asset classes. So the opportunity, for example, for them to be able, say, to lay off risk is there. Right. Whereas you may have, say, some of the institutional participants that are coming into the space that may be limited, say, to just trading, say, on the regulated platforms. Right. We've seen last year we added more than half a dozen, say, access providers. So these are providers, for example, that are providing access or providing liquidity on the unregulated platforms, but they're now, say, also integrated to the CME markets. Right. So that should lead, say, to greater liquidity in our space as well, as these new participants, bring their expertise into the market. Additionally, though, you've got all these new market participants that are coming to the space as well, and you've got a lot of availability, a lot of different trading opportunities for all these various players to benefit from.
Gotcha. Appreciate the additional insight there, Giovanni. Greg, there was something that I wanted to follow on and ask you. So you mentioned that there's still a sizable amount of edge left in market making today, and you mentioned that sort of $10 number relative to the $44,000 notional value of the underlying contract. I wanted to ask, how does that edge compare to TradFi markets? Is it like an order of magnitude larger? Is it relatively similar? Would appreciate any insight there.
Yeah, so it really depends, but like the liquid, SPY, for example, that edge is a lot less. If we go out to more exotic products in TradFi, you're going to have actually sort of bigger edges. But if we look into crypto space itself, what I expect to happen is, for example, as we get options listed on the spot ETF, I think those spreads will come down. CFI will still be sort of the benchmark. And then if you go out to the DeFi space, that edge gets a lot wider. So there's a little bit of a chicken and egg, especially if we look at sort of the exotic DeFi space. A lot of market makers can capture a big edge, but there's a lot of infrastructure costs in order to get going and provide markets there in sort of that nascent space. And so that's sort of the trade-off. Is it worth the infrastructure cost up front? Is there going to be enough taker volume to pay those larger spreads? But ultimately, I think that's a venue that will be really interesting. And I do think overall, as the spot Bitcoin ETF actually captures option market flow, we'll see a lot of interest there and smaller spreads there.
Gotcha. Thank you. As you approach the last question, this is a reminder that if you have any questions that you'd like to ask, please enter them in using the Q&A function at the bottom of your screen. So moving on to one of our last questions here. I think there's a lot of automated strategies, and you see this in ETFs or even on-chain crypto protocols that systematically sell volatility. So perhaps for Greg and potentially you too, do you mind commenting on the effectiveness of systematic volatility selling strategies, especially within the crypto options market?
Okay.
Greg, you want to start us off?
Yep, absolutely. Let me so Ewan and I developed, and some other players from the Amber Data team, shout out to Tony Stewart and Fabio Bassani, we developed gamma profiles so we could see essentially the true aggressor of each trade and then the market makers being on the other side. And so when we look at a time series of sort of gamma inventory per coin, Bitcoin versus ETH, we see two distinct trends. Bitcoin was really a year of 2023 of takers buying vol. And then in ETH, it was kind of the opposite. After the Shanghai upgrade, we saw takers actually selling vol. So ETH, for anyone who's sort of new to ETH as a product, is a proof of stake coin. So basically owning ETH, you can stake it and earn yield directly. You don't have to invest in mining infrastructure. And so what we saw here is this passive demand to buy ETH, stake ETH, and sell covered calls against it. And that's really when we saw sort of volatility selling strategies, volatility harvesting strategies. And those are similar to what we would see in traditional finance. Maybe Ewan, if you want to touch on that type of strategy.
Yeah, I think in a couple of ways, the crypto space has kind of been ahead of TradFi in this one. If you look at Uniswap, for example, all those Uniswap 2, I mean, that whole infrastructure was essentially based on the idea of you selling volatility. Being a provider in one of those swaps, you're essentially short a crazy looking straddle. Also, there were a lot of DeFi products that were essentially selling covered calls. And this gave a really nice way for traders on Deribit, for example, to get out ahead of that and trade against them. And we're beginning to see this now coming into TradFi, where there's a lot more institutional vehicles that are directly selling vol. And obviously everyone's whining about how this trade's now becoming crowded, and a crowded trade is kind of your punishment for being right. You know, I mean, if something's been making money for the last 3 years, of course more people are going to be interested in it. I mean, if you want to avoid something being crowded, you can always just do something that's losing money. No one's going to crowd you out of that one. But I think it's interesting. We're going to see, I mean, just last week, we saw in TradFi a bunch of ETFs listed that are selling zero DTE options as part of their strategy. I don't know how well they will do. It's much easier to list an ETF than it is to get volume. And you would think there's huge trading costs in that. But as the crypto world moves more into TradFi with more ETFs, I think we're going to see that sort of thing go there as well. So I think it's an interesting space for these kind of systematic vol selling strategies. And we've seen for a long time the vol premium on Bitcoin was enormous. You know, and it was driven by everyone wanting to buy options for directional plays, and they really weren't that price sensitive. So, I mean, that's great. If you're a vol trader, you sell it to them and you hedge it and you're all happy.
Yeah, definitely. I think we'd like to move on to the Q&A section. So once again, if you have any questions, feel free to enter them using the Q&A function. Starting off with an upcoming event that I'm sure everyone is very interested in, the Bitcoin halving. I think that's projected to be April 20th, so roughly 80 or so days out. And the question from Kevin is, how are institutions preparing for the potential market implications of this event? And how do you believe the expected supply shock is already reflected in the current market prices, or do you anticipate any significant adjustments post-halving? And I think it'll be interesting if you guys approach this question, if you guys are seeing anything in whether like options or futures that sort of like signal institutional investors positioning themselves for this event.
Yeah, I'm happy to kick that off. So what's interesting is Deribit recently launched their April contract expiration. So if I look at the term structure for at the money vol, there's about a 5-point premium that starts in April. And so it's a little bit of a vol, call it a kinks, so there's pricing for that event. What's really interesting to me, however, is that the halvening is a very predictable event, and you can essentially model that out. There's no surprises there. It's well known by the market, and it's well telegraphed, and everyone's known it for the past 15 years. So to me, I don't think there's a justified volatility premium to be had there. When I buy options, I'm really paying for some unknown. So that to me seems like a little bit of an edge. I think a lot of the market participants are pricing in that as a vol event. I don't particularly see it as a vol event. That's my opinion on it.
Yeah, maybe if I could add to that, certainly, we saw, Bitcoin rally last year, and that, of course, was driven, say, by the ETFs, but I think also, say, by the upcoming halving. We launched options, weekly options for all our April listings back at the beginning, toward the end of December, in anticipation, say, of interest or helping, say, market participants position themselves, for that event. And I anticipate, as we get closer, there is going to be, say, more interest, particularly, say, for Bitcoin. But I also think, what's interesting, and you and Greg, you guys spoke a little bit, say, about volatility, say, between Bitcoin and Ether. But when you look, say, at the relationship of Ether relative to Bitcoin, Ether generally underperformed Bitcoin all of last year. I think there was just 1 month when Ether performed better. But what we're seeing so far in January is Ether now, maybe in anticipation of say, its own potential spot ETF. We see Ether now rallying, say, more than Bitcoin. I think it's when you look at the Ether Bitcoin ratio futures that we launched back in July of last year, we're seeing that particular relationship of Ether outperforming Bitcoin by about 2% or so this year. So we do have an available product for market participants to say, take advantage of that trade, and that you could trade cash settled contract that represents a relationship between Ether and Bitcoin. So in other words, the number of Bitcoin that you would need, say, to trade one Ether, and we've seen that move significantly so far this month.
Gotcha. Yeah, I appreciate the insight there, guys. Moving on to the next question from Pushkara. This one's just for you, Ian. It's basically asking, what are the key differences between TradFi and crypto in trading vol? Can you use the same models that most traders use in TradFi and crypto, or perhaps are there certain nuances that you need to pay attention to?
The core models are the same, with the exception of the inverse nature of the options. But in terms of estimating the parameters, it's the same core model, but you do have slight differences that, like I said before, Bitcoin's 24/7. Yes. So you have to decide exactly how you're going to handle overnight jumps. But this is exactly the same problem you'll have if you're trading just standard equities. You have to make that decision anyway. So I would say the standard models all apply. I don't think there's much, the phenomena underlying how Bitcoin moves around, like, for example, the risk reversal flipping around, that's different, but the mathematics isn't. I use the same mathematics to analyze that risk reversal as I would on Microsoft or whatever.
Gotcha. Thank you. Next question, which is one I'm pretty interested in too. One of the greatest points or features of blockchain is that it's sort of like an open ledger, right? You can see all of the transactions, you can see all of the activity on chain, and as long as you have a computer, you can write some SQL or some code, you can probably query all of that, and it's so-called real-time financial insights. You don't need to wait for a 10K and 10Q go stalk the SEC website. So as the crypto market matures, do you guys think there are any emerging valuation frameworks that leverage wallet activity or perhaps on-chain data / signals to assess investor behavior? And how might this influence trading signals and financial analytics insights?
Yeah, I'm happy to jump in here. I think this is a short answer is yes. No one really knows how to value crypto yet. And then no one really knows how, the crypto vol correlations and relationships are going to persist into the future. And then lastly, we have a new set of data assets that no one has really figured out, has solved and figured out how to use. consistently for outsized profits yet. So we're kind of like in a new horizon of a new horizon and a new horizon. So looking at on-chain data to me is really interesting, especially if you start getting into the DeFi world or into this DeFi world. I remember like analyzing flows to and from Deribit in terms of deposits. We figured out their wallets and their master wallets with all their sub wallets, and seeing Ether being deposited to Deribit. That's a precursor to doing a vol trade. And so that's a really interesting data edge and information edge that you can get in crypto that you wouldn't be able to get in traditional finance. Another one is, when you're trading on a traditional brokerage, you don't know, all the interactive brokers, for example, accounts and their balances and their positions. If you start going to the DeFi space, all that stuff exactly. You can see all the wallets that trade on, say, Lyra or a different DeFi options protocol, and then you can see the P&L and how well each individual wallet has performed. You don't know if one wallet has a bunch of sub-account wallets. You don't know that, but you have a lot of information to give you an edge in terms of flows and different P&L performances. So I definitely think there's a lot of hidden treasure and gold there, and having the ability to analyze all that data to me is an edge.
Gotcha. Definitely agree there. I think one of the interesting points, like even for a centralized exchange like Deribit, right, you can sort of quote unquote stock their wallets on chain, look at how much collateral everyone is putting up there, and sort of reconcile that with the open trades. And perhaps there are some interesting insights or even opportunities that you can gather from there. The next question, how do capital flows, how are they influenced by different time zones? Basically, I think in the past few months, we've seen US leading by cumulative return by session for BTC, and that's followed by EU and APAC, which are roughly equal, but US is definitely leading there. So are there any identifiable trends, perhaps specifically in options and futures, that occur across various exchanges that could signal perhaps consistent time-based trading behaviors or opportunities?
Across our market, right, So our market is open Sunday evening 6 p.m. To Friday evening 5 p.m. and there's a 1 hour break between 5 and 6 every day. But we do see consistent volume across the trading day. I'd say close to 50% of a day's volume is traded, say, by around 8 a.m. New York time. So we are seeing flow consistently across the globe. I'd say we're probably seeing, to your point, Ren, the bulk of our volume is North America, but we've got about 25% coming out of EMEA, another 10 to 15% out of APAC, and then LATAM is still growing, but we probably have a little bit between like 1 to 2% coming out of that region. And I'd say, when you look at our product, right, we are where the market goes, say, for price discovery. We often lead the market in terms of price discovery. And we look at how much our futures are trading. Just this year, our volumes are up. When you look at Bitcoin and micro Bitcoin, our volumes are up over 66% compared to where we were in December. I think a lot of that is attributable to the growing ecosystem with the launch of these various spot ETFs. But even when you look across and include Ether, January so far is our best month. And best month since launch. We're up, say, over 55% when you include both the institutional and micro-sized Ether contracts as well.
Okay.
Yeah, one of the things that's really interesting when we compare venues, and especially geographies, is that there's a lot of insight provided. So in the CeFi world, there's CeFi on-ramps, off-ramps, which means you can convert fiat to crypto. But then there's also CeFi exchanges that are crypto only. And so, for example, in 2013, it was very clear that Mt. Gox was a broken exchange because it had the highest Bitcoin price. And you would think, well, why does it have a 15% premium spot Bitcoin price versus all the other exchanges? And the main reason was because the on-ramp, off-ramp for fiat broke down, and the only way to get your money out of Mt. Gox was to buy Bitcoin and transfer out Bitcoin. And so you can see those types of unusual activities. In 2017, we had Korea trading Ethereum at a large premium versus the rest of the world. So there's kind of all these different segments geographically speaking, and then there's different types of venues. So like the trader on CME is very different than the trader in DeFi for the most part. So you can personify sort of the investor base by doing that type of analysis. So all those things really give you a good idea of who's leading the market and who's following the market. And then based on that, you can have some sort of opinion. You know, if it's just DeFi degens bidding up vol, that's probably a fade. If it's, you know, a consistent pattern of maybe more institutional investors opening up new contracts into Q4 of last year, there's probably a trend there. So that's kind of how I like to think about it.
If I can jump in really quickly on this one, and this goes back to the question I was asked a few minutes ago. One of the really different things about Bitcoin, and again, you can use the standard models, but the phenomena is different. Bitcoin has enormous seasonality at the daily level, and I would bet that there's seasonality as well if you look at the different time zones. Like for example, a few years ago, everyone was very excited about the overnight effect in equities. That you find out equities really only ever went up overnight. There are almost certainly effects like that in crypto, and it's definitely something that's worth looking at. I never thought of it in those terms, like driven by different geographical areas. I was just like, you know what, 2 o'clock on a Monday morning, crypto goes up. But it's a great thing to look at. By the way, I have no idea if that's true, 2 o'clock on a Monday morning. But the data's out there. I think it'll be worth, you know, that's a pretty quick project. Be worth doing.
Mm-hmm. Yeah, I think.
Great, he's giving you some homework.
Time to put out the Python and run some backtests. One last question that I'd like to ask is one of the big stories of the past week has been the GBTC outflows and how that may not necessarily mean inflows into the new spot Bitcoin ETFs. Are there anything interesting that you guys are seeing in options and futures in terms of market dynamics that may perhaps help to signal what we could potentially be seeing into the spot Bitcoin ETFs?
Yeah, you know, I think it's interesting, right? When you look at you know what's happened, say with the launch of these spot products, you know, I think as some of my other panelists mentioned, you know, there was a lot of anticipation about the approval, right? So I think that there were you know some investors that put positions on in anticipation, say, of that approval, right? And once those products were approved, I think you saw some profit taking, right? You know, with respect, say, to the GBTC product, I think there you also had, because that particular product was trading at around an 8% discount to NAV just last month, right? And you know, the day, say, that the spot ETF started trading, that discount was under 2%, and I think now is essentially like closed out, you know. So I think that you saw some market participants that were probably long, say, GBTC, short futures, for example, and unwound some of those positions. So with that, you know, you saw, say, an outflow of holdings on the GBTC side. You saw, say, a decrease in Bitcoin futures open interest from its high, right? And then you saw, you know, some outflows as well, say, even from the BITO product, the futures-based product, right? BITO lost about 9%, GBTC lost about 20%, our futures dropped, say, about 16%. But when you look at open interest so far this month, for Bitcoin and micro Bitcoin futures, we're actually at an all-time high, even say with these outflows. So some of it, I think, was just really opportunistic trading. And then you see the inflows, say, to the spot products, or the spot products now we're probably added about 6 billion or so in terms of EUM. But what we're seeing, though, is that the ecosystem is growing. And I think it'll be it's going to be a bit of a long, bumpy ride, but I think, you know, what will happen over time is more and more people, registered advisors, are educating themselves on the use case for Bitcoin and helping to educate market participants on Bitcoin, and then the use, say, of ETFs as a wrapper, for example. The whole ecosystem will just continue growing, right? And it'll be a symbiotic relationship with the spot ETFs, the futures-based ETFs, as well as our futures contracts.
Yeah, I think that was a fantastic closing thought, to be honest. Yun, I'd like to pass it over to you. Do you have any final closing thoughts? And I'll pass it over to Greg.
Yeah, I think I've been thinking more about the original question I was asked about different models, and I'd come back to seasonality. If you're going to try and do a Garch type model, for example, you really have to include day of the week effects. Like whether it's on a Monday is very different from where it's on a Tuesday. So that's not really a closing thought so much as the fact I keep on thinking about this question and kind of modifying my answer.
All right, Greg.
Yeah, closing thoughts. I think, for anyone who's interested in trading these markets, Amber Data has all 4 pillars of data assets: on-chain data, market data, DeFi data, and derivatives data. It's really the place to look at everything in one place and find some edge. Again, I think this is a new asset class. People figure out how to value it. They're figuring out how the path of spot prices move, and then they're figuring out all the data assets and how to put it all together. So it's a really exciting space. There's definitely some nuggets of edge out there to make money.
All right. Thank you, Greg. Giovanni, any last closing thoughts on top of that fantastic statement, or?
I'm really excited, say, about the prospects for this year. We spoke a little bit, say, about the upcoming happening. Ether might have its own spot ETFs, so excited to see what happens there. But just really excited about the ecosystem growing and more institutions as well as individuals, retail individuals entering into the space.
All right. I think exciting is definitely the right word to use. Well, anyway, thank you everyone so much for joining us today for this webinar. Once again, I'd like to shout out our sponsor for this webinar, Amber Data. If you ever have any needs for on-chain market data, basically any data need within crypto, really, Amber Data is definitely the place to go. So check them out at amberdata.io. Thank you so much, everyone. And thank you, Greg, Ewan, and Giovanni for joining us today.
Thank you.
Thank you. Bye-bye. Bye all.
All right.
Recording.
As we can see, that was a great space hosted by Blockworks, talking about current market moves from Bitcoin's next frontier, institutional demand, and options and futures trading. Hope you were able to get a little bit out of this, and just sort of wanted to pass through this amazing information that we were able to get into. We did get several of our questions fielded. We did ask the hardball question at the end that everyone chose to not answer, about whether or not they own any crypto in a DeFi self-custody wallet versus, or if they're just SEX or CeFi traders. So, obviously that can be a contentious question sometimes when you're talking in the TradeFi world, but we hope that you love this information, and we'll see you at Taco Bites later on today. Have a great day.